Economic policies are the levers and pulleys that governments use to steer their economies. These policies, ranging from interest rate adjustments by central banks to government spending and taxation decisions, have profound effects on global markets. They influence inflation, growth, and the stability of the financial system. The global economy is deeply interconnected. When one country sneezes, the rest of the world catches a cold. A change in U.S. interest rates can send ripples through emerging markets, affecting borrowing costs and investment decisions. This essay will explore how recent economic policy decisions have shaped global markets, focusing on central bank actions, fiscal policies, and their impact on key economic indicators. By shedding light on these critical issues, we aim to provide readers with a clearer understanding of the global economic landscape and its potential trajectory. The global economy is currently navigating a period of significant uncertainty. After a surge in inflation in 2022, central banks around the world embarked on a series of interest rate hikes to combat rising prices. This aggressive monetary tightening has started to cool down the economy, with inflation projected to ease in the coming years. Despite this positive development, global growth is expected to remain steady but moderate at 3.2% in 2024 and 2025. Advanced economies, which implemented swift rate hikes, are experiencing a slowdown. Emerging markets, on the other hand, are projected to maintain stable growth of 4.2% in both 2024 and 2025, driven by strong performance in Asia. Central banks face a delicate balancing act, ensuring inflation is controlled without triggering a sharp economic downturn. The 2024 U.S. presidential election sent shockwaves through global markets. The unexpected victory of Donald Trump, who campaigned on a platform of economic nationalism and protectionism, ushered in a period of heightened uncertainty and volatility. The immediate impact was felt in currency markets, with the U.S. dollar surging against major currencies. The stock market reacted with a mix of optimism and apprehension. U.S. Treasury yields, a benchmark for global borrowing costs, rose on expectations of increased government spending and potential inflationary pressures. Higher U.S. Treasury yields tend to attract capital away from emerging markets, putting downward pressure on their currencies and increasing their borrowing costs. The possibility of increased trade barriers under a Trump administration has raised concerns about a potential slowdown in global trade, which would disproportionately impact export-oriented emerging economies. As the global economy grapples with the aftershocks of the 2024 U.S. election and ongoing geopolitical tensions, the role of central banks has become even more critical. With inflation showing signs of easing, many central banks have started to shift away from aggressive interest rate hikes. In this complex environment, fiscal policy also plays a crucial role. Governments need to strike a balance between providing support to their economies and ensuring long-term fiscal sustainability. Emerging markets face the challenge of navigating a global landscape characterized by tighter financial conditions and increased uncertainty. They need to pursue sound macroeconomic policies, including maintaining fiscal discipline, strengthening their financial systems, and implementing structural reforms that promote competitiveness. By understanding the forces at play and the potential risks and opportunities, businesses, investors, and policymakers can navigate this complex landscape and position themselves for success in the years to come.